Warren Buffett has been doing this for, over 80 years now? And he's got this almost legendary ability to just glance at a company's financials and boom, he gets it. He knows if it's healthy or not, just like that. So what if you could do the same thing? Well, today, we're going to unpack the exact method he uses. It's simpler than you think.
So how do you even develop a skill like that? I mean, financial statements can be a lot. Just pages and pages of numbers. How do you cut through all that noise to find what actually matters? It sounds super complicated, right? But stick with me, because the core idea here is actually surprisingly simple.
All right, let's get right into it. The secret sauce, if you will, is this simple 5-point checklist. It's Buffett's go-to rule of thumb. And in this explainer, that's exactly what we're going to do. Break down that checklist one step at a time.
Okay, but first, a super quick refresher so we're all on the same page. We're going to be living in the balance sheet for this. Think of it like a financial snapshot of a company on a single day. On one side, you have everything the company owns. That's its assets. And on the other side, you have everything it owes. That's its liabilities, plus whatever's left over for the owners, which is the equity. And here's the key. Both sides have to, balance. That's why it's called a balance sheet.
All right, here we go. Time for the main event. Let's dig into Buffett's 5 rules. Seriously, think of these as a set of quick X-ray glasses that let you see a company's financial skeleton almost instantly.
First up, rule number 1. This one is probably the easiest one to check. It's a simple question. Does the company have more cash than it has debt? That's it.
So what Buffett is looking for is simple. More cash and easy-to-access investments than total debt. But the why behind it is what's so brilliant. He absolutely loves businesses that are just cash-generating machines. They're so profitable that they don't even need to borrow money to grow or operate. It's just a huge flashing sign of a healthy, self-sufficient company.
Okay, moving right along to rule number 2, and this one kind of builds on that same idea of financial strength. It's all about looking at how a company is paying for everything. Is it piling on debt, or is it using its own money to fund its growth?
The metric here is the debt-to-equity ratio, and it's just what it sounds like. You take the company's total liabilities and divide them by the shareholders' equity. Now, Buffett has a very specific number in mind. He wants that ratio to be below 0.8. And you can see the theme here, right? It all comes back to the same philosophy. He prefers companies that aren't leaning on debt. A low number here is a big thumbs up. Now, rule number 3 is a little different. Think of this one as more of a red flag detector. We're not looking for a number, we're actually looking for something to be missing. So what is it? Preferred stock. Buffett wants to see a big, fat 0 next to this line item. And why is that? Well, you can think of preferred stock as this weird hybrid. It's kind of like debt, kind of like equity. It comes with strings attached. And the bottom line is, the really strong, powerhouse companies, they're so profitable, they just don't need to use these kinds of complex ways to raise cash. So if you see 0, that's a fantastic sign. All right, for our 4th rule, we're shifting gears a little. So far, we've been looking at a snapshot in time. Now, we're going to look at the movie. We want to see a company's track record of making money and what it does with those profits. And we do that by looking at retained earnings. This number is basically the running total of all the profits the company has ever made and decided to keep and plow back into the business. And what Buffett wants to see is simple. That number needs to be consistently going up, year after year, especially if it keeps growing even during tough times like a recession. That's how you spot a truly durable business that knows how to invest in itself.
And that brings us to our 5th and final rule. This one is all about how the company treats its owners, the shareholders. For this, we're looking for something called treasury stock. It sounds complicated, but it's not. This line just shows how much money the company has spent buying back its own stock from the market. Buffett loves to see this because it's a direct way of returning cash to shareholders. Think about it. When they buy back shares, there are fewer shares out there, which makes each one you own a little bit more valuable. It's a classic sign of a shareholder-friendly management team. Okay, so that's the theory, 5 rules. Sounds pretty good, right? But how does it actually work in the real world? Let's put this checklist to the test right now with a company everyone knows, Chipotle. All right, let's run Chipotle's report card. Rule 1, cash versus debt. They've got over $1.4 billion in cash and 0 traditional debt. That's a huge pass. Check. Rule 3, preferred stock. Nope, none listed. Another pass. Check. Rule 4, retained earnings, growing consistently for years. Pass. Check. And Rule 5, treasury stock. Oh yeah, they've bought back over $5 billion worth. Another big check. So, 4 easy passes. But what about rule number 2, that debt-to-equity ratio? When you just run the numbers, Chipotle's debt-to-equity ratio comes out to 1.2. And remember, Buffett's magic number, his line in the sand, is below 0.8.
So, on paper, that's a fail. Plain and simple. Case closed, right? Move on? Well, not so fast. This is a perfect example of where you have to be more than just a number cruncher.
Because the single most important question you can ask, especially when a number looks off, is this: what's the story behind the number? Because numbers without context, they can lie to you.
And with Chipotle, there's a really interesting story. First off, their biggest liability isn't debt from a bank. It's actually the rent they owe on their restaurant leases for years to come. That's counted as a liability. Second, remember that $5 billion in stock they bought back? Well, when a company does that, it actually reduces the shareholder equity number on the balance sheet. So you've got a bigger liability number from leases and a smaller equity number from buybacks, and suddenly that ratio looks way higher than it really is. See how the context changes everything?
So once you add that crucial context, what looked like a fail is actually a solid pass. And this is such a great lesson. These rules of thumb are an amazing starting point, but they're not the end of the story.
So, let's wrap this up. What's the big takeaway here? How can you take this 5-point checklist and start using it yourself?
Let's run through it one last time. Here it is. Buffett's 5-second test. 1. More cash than debt. 2. Debt to equity ratio under 0.8. But hey, remember to look for the story behind the number. 3. No preferred stock. 4. Constantly growing retained earnings. And 5. It has treasury stock, meaning it's buying back shares. That's it. It's an incredibly powerful toolkit to have.
Look, this simple checklist just pulls back the curtain on the balance sheet. It gives you this powerful lens to see a company the way an investing legend does. So really, the only question left for you is, which company's balance sheet are you going to check first?